All right. Good afternoon, everyone. There's probably a few more trickling in. Thank you for joining us today. My name is Carolyn Mullins, and I'm a financial planner here at 12 Points. But I'm here today as a young investor. Barbara Mayetta is my colleague and a wealth advisor at 12 Points, and I asked Barbara if she'd be willing to share with us today what she would tell do-it-yourself investors to think about when they're investing their own money.
I'm Barbara Mayetta, and I'm a wealth advisor here. Work very closely with Carolyn, and we often get asked questions about how to invest their money. And there's so much more to investing than picking the right stock. And that's a lot of what we will go through today, which are all of the things to think about to prepare for picking the right stock. And then we're really going to stay more on thinking about, picking the right mutual fund or ETF and how to evaluate those. But first, how to decide what to put into your portfolio. So, Carolyn, I really look forward to this. I'm really happy that you are suggesting this topic because we do hear in comments from people that this is a topic they want to know more about because people are doing some of their own investing.
Great. I'm excited to learn. So, Barbara, I've been investing in my 401k at work, and I also invest some money in an individual side brokerage account. But how does somebody get started with investing their own money, especially when they don't have access to professional investment management?
So, Carolyn, as I just mentioned, there's so many things to think about before you spend or invest that first dollar. And the first thing we want to think about is what are your goals? And now you just mentioned a couple, and those are very common goals, especially for folks in their 20s and 30s. So we'll kind of play with both of those a little bit. But one, and the one that everybody hopefully has, is I want to say one of my goals is to be prepared for retirement. And if you're saving for retirement, it's a long-term goal, 20, 40, 60. Remember that it's not just the number of years till you get to retirement, but then it's also the number of years you're in retirement. And if you didn't catch from the last page, I should mention, hey, I'm used to working with people who are in early retirement. So they're still investing for another, 25 to 30 years. So long-term savings, everybody's doing it. And the goal of this is to replace income at some point, to use it up once you're retired. There are some real advantages in taxes when you're saving for retirement. And look into that. We're going to mention some specific accounts here, but look into what those advantages are and make sure you understand them. Some of the downsides or things you need to be aware of with retirement accounts is that usually there's a penalty if you're going to take the money out before you're 59 and a half. We also have, like you, Carolyn, people who are thinking about shorter term goals. Hey, I want to buy a house at some point. I need a lot of money. I need to save for that. Maybe that's 1 year away. Maybe it's 10 years away. And maybe you need like somewhere between 5 and 20% of the home price. If you're saving for that, you want money that's going to have some safety. No, maybe it's 100%, couldn't lose a dollar of it, or maybe I'm willing to invest a little bit, but I don't want to be exposing myself to a 20% risk loss if the market goes down. And so that's what I think the important things to think about is what is my goal? Because that's going to change the way I invest.
Okay, so I've got my retirement savings and I've got my down payment savings. Exactly which accounts? Am I doing the 401k and the brokerage account correctly for those two?
So I think there are different accounts to look at if you're if you're saving for retirement. The best kind are often the kinds offered as with employer plans. Those are 401ks, 403bs, 457s. It depends upon what industry you're working in. And In this case, many times your employer will give you a match. You want to make sure you're investing enough to get that employer match. That's free money. There are some challenges to both these type of accounts and traditional IRAs because there are limits as to how much you can put in every year. So you might be putting money into your 401k, which is going to be more like for most people, it's going to be somewhere around $24,000 a year. And for traditional, it's going to be somewhere around $7,500 a year. Same thing with the Roth. The thing about Roths, we love Roths because you put money in that you have already paid taxes on, but it can grow until you take it out tax free. But you can't take it out once again until you're 59 and a half without getting some penalties on the earnings. You can take out the money you've put in without having a penalty. For your house, Carolyn, if you think this is something you're going to do in less than a few years, use a high yield savings account. It's 100% safe. You can't lose any money, but it's also not going to pay you a lot of interest. Right now, maybe it's 3.25-ish or something, somewhere in that ballpark. But if you're maybe a few years out further than that, you have a little bit of time to take a little loss and earn it back. A brokerage account, you can put in some stocks or some bonds that might make a little bit more, maybe something that earns a lot of dividends, doesn't have as much volatility to it. And it can be flexible and there's no contribution limit.
Okay,
So
great.
at this point, I do want to talk as we go on here. I'm going to be kind of talking a little bit about this is developing a plan for you.
Okay.
So here's from the last page we were on, the first thing in your plan is what's your goal? Make sure you understand what goals you're saving for. And from here, what type of accounts are you going to use? So now I've got two pieces to my plan already.
Okay, so we went through the different accounts, and like I said, I have a couple opened and set up, but what do I put in those accounts? What do I invest in? Do I just, find a company and buy a stock of Apple? I'm struggling with the what goes in those accounts.
Yeah, I'm going to talk more about this later, but one of the things that's really important in investing is thinking about diversification. So if you went out tomorrow and said, hey, I want to go put stocks in my account, well, you'd go out and you'd probably find 10 at the most, and you'd put them in. And the challenge that you have then is your exposure is just 10 stocks, and they could easily lose money. One great way to spread out the risk, which lowers your sort of downside, is using mutual funds or ETFs, what are otherwise called electronically traded funds. These are two very common ways of buying stocks and bonds and putting them in your accounts. They are basically a way of pooling your investment. Pooling your money with a lot of other people, and then hiring a professional manager to decide how to invest your money. So let's say I want to invest like the S&P 500, right? Lots of stocks. I could buy a mutual fund that is set up to mimic the S&P 500. Basically, invest a little bit in all of the stocks that are in the S&P 500. I can also buy an ETF that does that. So what's the difference between the two? That for mutual funds, in addition to doing the index funds, like I just mentioned with the S&P 500, I also more likely can buy a nice professionally managed stock fund that focuses on maybe a specific area. Maybe it's going to be large stocks. Maybe it's going to be international stocks. And it's professionally managed, but someone who is being paid to try to beat the benchmarks, not just make it to the benchmarks, mimic what's in the benchmarks so that I am trying to get what the benchmarks are making. Why is that good? Well, obviously, maybe they can beat it and get a little bit more, and maybe more importantly, when these markets are falling a little bit, they can take a little bit safer approach than staying with the benchmark when the benchmark is going down a lot. Mutual funds, you buy it after the end of the day, after the end of the trading day. The trading day is 9:30 to 4. It's priced once a day, and I put in my order while the market is open, and my trade will take place overnight. ETFs are priced throughout the day, and I can buy them real time. Investment style, mutual funds will tend to be more actively managed. ETFs will tend to be more passive, or what we call index. The mutual funds may have a minimum investment, somewhere between 500, 3,000. But for retirement accounts, often that is waived because they know you're going to set up a once a month deposit with your paycheck. There's no minimum usually on ETFs, other than maybe you can need to buy one share, although a few of them allow fractional shares. The thing to watch with these is expenses, commissions, and loads. On mutual funds, the expense ratio can be somewhere between maybe 50 basis points and 150 basis points, so that's 0.5% and 1.5% if it's actively managed. If it is a index fund, maybe you're paying 0.05%. What you want to be careful of in mutual funds is that some want to charge what they call a front-end sales load. That can vary a lot, but it can go up over 5%, or it has a back-end redemption fees. Usually that's when you're buying it through a broker, but that's paying a lot, and you don't really want to buy it that way if you can avoid that. And for ETFs, they have low expense ratios and no sales loads, which is nice. Some companies might charge, when your trading platform, a small trading fee. But if you're trading with somebody like a Fidelity or a Schwab, you probably aren't paying any at all.
Okay. Wow, that's a lot.
So
Mhm.
my one suggestion there would be choose one or the other to start with. Choose a mutual fund or choose an ETF.
Okay. I have two questions from here. You mentioned that this is better to diversify because it holds many different companies, and like I see here, it's a pooled investment or it's a basket of stocks and bonds. I'd love you to talk more about what that diversification really means, and is that one mutual fund I hold and now I'm diversified, and then the other is you're mentioning stocks and bonds. Should I be using one or the other or both in one?
Okay, you bring me right to my favorite subject. But I'm going to start with, I love diversification because that's really so important to help you reach your goal. The mutual funds can give you a lot of diversification, but sometimes you're going to want different mutual funds to help you spread even further. But if I look at what I think of as being kind of a good, you see on the screen here, a moderate portfolio. So if I'm somebody who thinks my risk tolerance is, I don't want to be extremely aggressive and, be taking large, the whole market goes down, I go down as far as the whole market does. Maybe I want to be a little protected from what the stock market's going to do. So it would make me really nervous if the stock market goes down 30% and I just took that ride down. So maybe I want something a little less, call it moderate. Um, I'm going to want some combination of stocks and bonds, maybe even some real estate. Real estate is sold in something called a REIT, REIT. Maybe I still leave a little bit in cash, and if not cash, maybe it's a little bit in some kind of treasury bond or treasury fund. Um, why we do this is that if stocks start going down, bonds don't always go down. So if stocks sink, maybe bonds don't, maybe real estate doesn't. So having a split between stocks and bonds, throwing in some diversification between with sectors. Sectors are really industry or geographies, right? That the U.S. might go into recession, but Europe doesn't. So being in different geographical regions. So that's throwing in some international. Um, one thing about diversification, the way I think about it is, um, if I'm invested in the whole market, I'm in the S&P 500. Um, then when the stock market goes down, a lot of stocks are going to go down, and this is called market risk. So the risk that for some reason or another there's going to be a recession, some reason that the whole market goes down, in which case almost all the members, almost all of the funds and stocks are going to go down. But the so that's market risk. It's really hard to diversify away from market risk. But if I invest in, say, technology, that would be an industry. Well, technology could go down, but the whole market doesn't go down. So if I'm just in technology, I have got sector risk and I've got market risk because if the whole market goes down, it will probably take technology with it. But if technology takes a hit, like there's a shortage of microchips, and so that case, technology might go down, but that doesn't take the whole market down. And then if I invest in just one stock, that one stock might go down, but not necessarily take the whole sector it's in down with it. I think of Enron, for those of you who are old enough to remember. Enron was one company, went down. A lot of people lost a lot of money, but it was due to an accounting fraud. Matter of fact, that took down Arthur Andersen as a big eight accounting firm at that point. And so you have risks at different levels. If I'm diversified enough, I can diversify away from that one stock, one one sector. So it's important to understand what I'm really invested in. We already talked a little bit about matching your time horizon to how you're investing. It's important to, even though once you decide what I'm diversified, make sure you're rebalancing. And with what your diversification does help manage risk, but it's not going to eliminate it completely because you can't really eliminate market risk. I think I'm going to take you right into the discussion because we're talking about eliminating risks and keeping risk limited. It's important to understand your personal risk assessment. What is, and I want you at the end of this to think about, what's your risk profile here? Are you really conservative? It might be because you're on a short time horizon. It might also be because you're not going to sleep at night if the market goes down 10%. And then if the market goes down 10% and you're not and you're aggressively invested, you're probably going to start selling at that point. And you don't really want to sell when the market is down because then you're not going to take the ride back up again. But lots of people out there, young people, Carolyn, you tell me, are you more moderate or more aggressive?
I'm gonna say more aggressive, but I think I'm biased where my experience with the market and with investing has only been recently. And we talk about clients and individuals who are around for 2008 and other times of periods of time where it didn't look like the past 2 or 3 years. I've only really seen and experimented in the past 2 or 3 years, and Barbara likes to remind me sometimes it doesn't always look like that.
Well, in the last 20 years, we basically had, a lot of upside here, right? Since, 2008, 2009 was the bottom. And other than little blips, I'll say, right during the pandemic, if everybody remembers March, boom, it went down, but it came back up right as quickly. And then 2002, we had a market downturn. But yeah, if you're more, hey, if I'm really aggressive, this is going to be your retirement account, right? This is going to be, I know I'm not going to use this money for 20, 30 years. I have more than 15 years to recover if there is a big swing. And I'm not going to worry about it if there is a big swing because I understand enough about the market to know that, it does recover. And I don't need to move the money, use the money before it recovers. Or sometimes we used to say, it doesn't really matter how much money I have today. What matters is how much money I have when I start taking it out of the account. So yeah, it went down fine, but I'm not taking it out of the account right now. And a lot of people are going to find themselves somewhere between moderate and aggressive if they're younger, or between moderate and conservative if they're older. I think one of the things I do want everyone here to think about in what's your risk and therefore how much you're going to have in stocks and bonds is thinking about if you've experienced 2002 as an investor, or, the couple of months during the pandemic in 2020 when the market went way down, came back up right away, or if you're old enough to remember 2008, during those times, did you go out and sell because you got nervous? Or did you just hold because you knew, oh, I'm invested right, and therefore I can stay with this model? What I want you to think about now is, what is your risk? And with that risk, take a look at, okay, what percentage might I be in stocks and bonds based on those risks?
Right. I'm thinking about, I know you mentioned it, but I'm thinking in my head about my retirement accounts that I am a little more aggressive because of the time horizon, but my savings for a down payment, you mentioned maybe even in a high yield savings account so that it's very stable, or other savings maybe more towards goals 7 to 10 years out. I can be invested, but more towards the left side of conservative over here. Okay. And so I see stocks and bonds. I pick a couple stock mutual funds, like maybe some bond mutual funds or ETFs. Is it as easy as that? Or you mentioned uh, sectors, you mentioned technology. Can you expand on that?
You are absolutely on the right track, Carolyn. What we would normally say, there are, in mutual funds and ETFs, there are lots of different themes to be choosing from. And I'm taking this to a pretty high level here to say think about the far left, broad market. These are your S&P 500, your total stock market. These are all things you're going to see in the names of mutual funds. So they're S&P 500, total stock market, Russell 2000. Russell 2000 invests in small cap funds. Small cap means these are small companies. Cap means capitalization. So large cap means really big companies like your Apples and your Microsofts, and small cap's going to be companies that you've only heard of because you have somebody that works there. And then there's also mid cap in between. That might be something like the S&P has a one called S&P Mid Cap 400. But you can really easily go on to a Fidelity, Schwab, a Vanguard type of site and do some search by different capitalizations, or also by growth and value, and get funds, look at funds that are broadly invested. We suggest you start there. That's a really, really good place to start. There's also the sector funds. So you could go out there and find ones that are invested totally in technology and maybe even technology to the point of saying technology and it's going to be chips or it's going to be technology and it's going to be, space or healthcare. Healthcare is one that's very popular these days because as the population ages, everybody believes there's so much more that's going to be done here, and therefore, these are going to be growth industries. Energy is also a big one. We've seen a lot of growth there, but you can actually get into like green energy or clean energy. There's lots of different funds that get even more specific. So you can pick a sector that you really like and have some belief in, but don't put everything in there, right? This is use it sparingly, 5-15% to go in these, and I wouldn't say 15% in any one. The other thing I really want you to watch for here, we're going to bring this up again, is these broad market funds that we're looking at here. If you get one that's maybe not a index fund like to the S&P 500 or the Russell 2000, but it's actually just like a large cap growth fund. You might find that they're already heavy in technology. So you want to make sure that you're looking at, later we're going to tell you, look at the top 10 holdings and look to see, well, how much of that is technology? Do I need a technology sector fund or do I already have enough in technology because of the broader funds that I'm invested in, because there is so much in technology right now. Bond, yes, this is where you go to buy bonds. Buying individual bonds is even harder than it is to buy an individual stock. There are lots of different types. U.S. Treasuries would be very conservative, whereas corporate bonds are going to be less conservative. But with that said, they're also going to pay a little more interest. Municipal bonds, the advantage to those, if you buy them in the municipality where you live, you might get triple tax and get triple tax free. Once again, bonds are something that you're buying to help reduce the volatility of your portfolio. The returns are not going to be as high as stock, but a good thing to have in there to keep or reduce some of the volatility. International used to be thought of as, oh, that's where there's a lot of growth, and there still is, especially in emerging markets. But sometimes it's just hey, the U.S. market right now is very stagnant, and maybe there's still a lot of growth in Europe going on. So try to get some exposure to different, to the international stock and the international market. 15 to 30% is not a bad use. And then for folks who are a little older, who are looking to invest in stocks, but want to also get some income coming, and they think, oh, to get income, I need to buy bonds. You can also buy dividend mutual funds or a dividend index ETF. And dividend stocks are ones that the stocks are paying high dividends. Might still have some growth and appreciation, but they're paying out the dividend, and those dividends can get paid out to you. What I'd like you to think about now, and Carolyn, maybe even, we don't take this just for you because it might not be right, but think about on this page here from the page before, we said, okay, well, maybe you want to be 85% stock. Okay, well, how would I distribute that here? Well, you really liked technology and health, so maybe you go 10% between, technology and health, 5% each. You should throw some international in there. You don't have a lot of experience at that, so, go with 10% in international to start. Bonds, since we said you wanted to be 85% stock, that's 15% bonds. And then the rest, which would be 65%, you can go broader market. So this kind of how you at this point start and say, okay, what's my allocation to different types of the themes across mutual funds? And from here, that's at this point a really good place in your plan. As a matter of fact, that is kind of what your plan ought to have is what, how long do I want to be? Excuse me, how long do I want to be investing for? So that's getting to what are my goals? What type of accounts do I have? Mutual funds, ETFs, my risk, and that's going to drive what my percentage is in different types of mutual funds, which is really kind of different types of stocks, right?
Okay, yeah, that's very helpful. So as I think about my experience going on my account, picking exactly what to put my money in, what to buy, I I just feel like if I were to look up international, there would be so many different options. There's not just one international fund that's a mutual fund or an ETF, and I just click this one. I feel like there's always a lot of options even within those. How do I further
Oh,
know exactly which one?
oh my God, there are so many, aren't there, Carolyn?
Yeah.
I feel so overwhelmed with that too. And then you say, gosh, how do people even buy individual stocks? It's so hard to buy an individual mutual fund. Um, so the first thing to do is once again, somebody like a Fidelity, Schwab, Vanguard, others do have search engines to be able to put in a few parameters, and then will narrow it down. And then within for each of those funds, they should have a fact sheet or a prospectus available. Love to start with the fact sheet because it's usually, done a little bit more as a marketing piece, so it's easier to read, and a little less, long paragraphs and lots more bullet points. So start with the fact sheet. If you can't find the information in the fact sheet, um, we're going to send you to the prospectus. But want you to pick what mutual fund you want to be in. Yeah, great. Go to the technology, get a list of 5 or 6 of them. And then what I want you to do is look at the costs. I want you to look at things like what's the expense ratio? Are there sales loads 12B1 fees? 12B1 fees are marketing fees. They're kind of hidden sales fees. But make sure that what you're buying doesn't have 12B1 fees. I want you to pay for the investment managing your expertise. I don't want you to be paying for someone to tell you what mutual fund to buy because that's going to be paying 5 or 6% of what you're investing, and that's pretty heavy. So look at the costs associated with it. I also want you to look at performance, but I also want to be really careful here to say don't chase performance. We always keep saying in the industry that past performance is not an indicator of future performance, and then a lot of people will tell you, but yeah, it really is. So drop down here from performance to manager there, okay? The performance is often driven by the manager or the managing team. So take a look at the tenure of who's managing that fund. And if that manager has been there 3+ years, then they probably have had some time to show you what they can do. If there's a brand new manager and they've been there 1 year, I'd say, well, wait a minute, this manager isn't showing me what they can do yet. So maybe I want to buy a fund that has had good performance and a long tenured manager. There's also, you can find here whether the manager has a large ownership interest in that fund. And lots do that just to show you they're really confident in their own investment style. What a great way to know that they believe that they're the best manager is by putting their money where their mouth is. So take a look at performance 1, 3, 5, 10 years. You want to make sure that they do pretty good across that. And if in that time frame there's a bull market and a bear market, compare and see how they did, right? Did they seem to drop more than the market did during a bear market? Um, because that really matters. When you start losing money, you want to make sure that your manager can handle this fund in a bear market. What kind of risk is in your fund? This one's a little harder. I usually just stay focused on the standard deviation. But there are other risk measures that are sometimes shown in the fact sheets. Compare them, right? If I can get the same type of management style with less risk, but still has good performance, then maybe I go a little less risk. As we mentioned before, I want you to make sure you understand what's in the holdings. So am I buying the broad market? Am I buying large cap? Am I buying growth versus value? So make sure you understand and that you are diversifying along those lines. And then the last one we mentioned before, top 10 holdings. Oh, Carolyn, tell the story here on one of our recent clients here on top 10 holdings.
So we had a recent client or prospective client come in. We're looking at her statements of what she was invested in before she comes on board with us. And there was about 8 different mutual funds, maybe across different sectors, across different markets, and might look okay from the surface. But our chief investment officer here has a software that can actually, remember we said that the mutual funds are pools of investments and a bunch of different companies in them. So our chief investment officer has a software that can actually pull out what exactly is in that pool. And when you look at those 8 different mutual funds, what each one of them is invested in, 50 to 60% of her money was in 7 different companies because all these mutual funds wanted to get a hold of the earnings, the profits of these big companies, not knowing that her entire, retirement account was banking on these 7 companies.
Yep, pretty amazing. So all of these fact sheets or prospectuses are required to show you what the top 10 holdings are at least. Some of them even show more than that. So check and make sure that in picking 3 different funds, Apple, Nvidia, Tesla are not, in the top 3, the top 10 of all of them, and that, you're going to end up with, 20% of your holdings in those 3 stocks because those are the big holdings on all of them. So, what I'd say is that on the last page here, we said, figure out where you're going to invest, what percent in each of these, explore some funds, depending upon what percentage you would put in each of these, and then do some looking at, what mutual funds are best in those categories based on what your criteria is. That makes
All
sense,
right.
Carolyn? You ready to go out and
Yes.
start diving into that?
I was going to say I have a lot of homework to do and research to look at where I'm standing today and where the new money goes into later weeks. So as I'm doing that, I'm thinking there's a lot to process here. There's a lot to think about. Is there anything I shouldn't be doing and should watch out for? What have you seen gone wrong?
Well, we certainly see common mistakes. Um, and one is starting without the plan, right? And I think I mentioned as we went through this, right? What are the things, your goals, the type of accounts, money, mutual funds versus ETFs, your investment risk, and what's your allocation going to be? That's basically your plan. And then you can buy funds to go into that. One of the interesting ones that we see is a lot of emotional decision making. We had a client who had one of the Magnificent Seven, and they had about 5/6 of their entire portfolio in one fund because they've been in this fund for 15 years and it's done very, very well. So they want to stay there. Wait a minute. What happens when that one fund decides to crash right before you need it? because there is no guarantee, right? There was Enron, there was the Silicon Valley Trust Bank 2 years ago, right? Where you just don't know, no matter how big it is, it can still go really far down. And you don't want that to be your one. So don't get locked and loaded on this is the best. There are times when it's just good to take your profit and diversify. Don't chase past performance, right? Look for that consistency, because past performance is not an indication of future performance. I love saying that all over the place. Home country bias, yeah, we see a lot of people coming in who don't have any international at all. Why? Because they think, oh, I should know something about, I don't use products from those companies. I don't see those company names at all. I don't know how to pick a international mutual fund. Yeah, you pick it the same way you would pick any mutual fund. You evaluate it closely, but let them tell you what markets it's in, and just make sure that you're hitting some of those international markets. Timing the market, don't do it. There's lots of studies out there. When we say timing the market, it means, oh, I think there's going to be a recession, so I'm going to pull everything out and go cash now, and then I'll buy when you're at the bottom of the market. And one, nobody gets it right. And there's lots of interesting studies out there showing that, I don't know, if in the last 50 years, if you miss the bottom of the market, you sold, 2 days after or 2 days before the bottom of the market, and then you begin buying, you sell what you think's the top of the market. It's not really the top of the market, right? You miss the last few days going up before it comes down, and you miss the bottom of the market to start buying. And this is the one people mostly miss, which is the market keeps going down and they think it's at the bottom and they buy, and whoops, nope, it keeps going down more. Or it turns around and you think, well, it's not really turning around, that's just a flip up for a few days, and next thing you know, you discover the market's up 15%. It's not going back down, and you miss that 15% coming out of the bottom. And there's lots of people have done studies, and if you miss these by just a couple of days, either way, you actually, are 20% lower than the person who rode it out. Riding it out is the best way if you have time. Over concentration, we've probably hit on this over and over again too much here, right? Don't own one stock or a lot of it. Don't make a major centerpiece of your portfolio over concentration. You might get rich doing that. More likely, you'll get poor doing it. So I think that kind of wraps up at least what Carol and I discussed saying. With the important point here is, it's not about picking the right stock. It's making sure you have a plan, that you stick with the plan, you're disciplined in how you do it. And then you will long-term have better results in with your portfolio.
Well, thank you, Barbara, for this insightful information. I hope our listeners got something out of it, and whether they were on or whether they signed up and weren't able to make it, the recording will go out via email and will be up on our site. Usually takes a week or two, and if you look at that recording, maybe you can pause on some slides and walk through your portfolio, thinking about these different things.
And I think we're going to have a blog coming out probably in about a week too. So if you want to see some of this in writing, watch on our site for a blog, probably with this same name as this webinar.
And if you have any questions, it's either Barbara@12points.com or Carolyn@12points.com. All one word, 12, or written out 12 points. But thank you for joining us. Bye.